I mean, if you run a fund that's solving problems that help the world and you're making money, that's awesome. I mean, and like, it just makes your selection process a little bit more tighter. But yeah, if that's what makes you happy, that's awesome. I mean, look, for instance, the SEAF, right, which is kind of the parent organization to CEED, they're a nonprofit, but they invest in companies as a corporation. I think that's an awesome, awesome model. And yeah, it came out of people wanting to encourage entrepreneurship around this region and, you know, developing countries. So stuff like that, I 100% support, because you're acting as a capitalist, but you also, in your back of your head, are just filtering it differently. That's really what it is, I think.
I just don't think that the pure venture model really lends itself well to these kind of businesses. So we have, for example, I helped one company that started out as a real internet mobile startup around content. They were trying to raise venture capital. At the end of the day, actually, an endowment that's basically about spreading interesting, non-governmental, non-commercial content, actually invested in that company and kind of turned that company around into real social entrepreneurship project, basically. And that was the best thing that could have happened for that company, because they wouldn't have got money and they would have basically gone down. But once this investment happened, it was very clear it's a different perspective. It's not about selling the company in 5 years. It's not about these, at the end of the day, technology businesses. So I think you really have to make a decision at the end of the day. But yeah.
Okay, we had a question over here. In the meantime, I just noticed something that the fact that I find this meaningful is commentary on the hollowness on my head. But now that we turned the seats around, everyone who leaves and comes back, they do it in front of everybody else. It requires courage and bravery. I commend you.
Or you gotta feel really bad.
And it's also a commentary on what we're doing over here. So
we have a nice view.
Yes. All right, so go ahead, sir.
Hi. Investing in a company is purely the first step of the process, but I would like to know if there are any different exit scenarios. Are there any timetables of the investment, and how does the whole process finishes at the end?
As far as our fund is concerned, we are a typical VC fund, so we have to close our fund in 10 years' time. So that's the time frame that we are operating in. We are usually, I mean, we expect to make exits only with, or in great majority, with other investors in later rounds, and we plan to do exits through M&A deals. Not so much on some IPOs, although the Warsaw Stock Exchange presented today as one of the, I think, the only market here in the region that can be appropriate for our companies, but otherwise we expect exits through the sales to the corporates.
All right.
Yeah, similar. I mean, at the end of the day, this is the logical path, especially for European companies. I mean, there is, for the VC itself, there's maybe an opportunity to, if you're in there in the early stage, like us, then you can sometimes sell your share to the later stage VC, but that's unusual, doesn't help the company. So.
Yeah, we are a bit different than a fund, because we are not a fund, so we don't have to close. Funds are usually partnerships organized for a fixed period of time, so at the end of this period they need to close. We are not better, but it just happens that we are part of Intel and we only invest Intel's money, which means that we don't have a pressure to sell at any point in time. If we like the company, if the company continues to grow, we can be a very, very patient investor. And actually, I think it's quite unique. Our longest investment to date was 19 years. We exited last year through an IPO. So we do everything, M&A, so sales to strategics, we do IPOs, everything in between.
And for us, it's our personal money, so we don't really have a time frame like a fund either, but we expect to kind of see things in a 5 to 7 year time frame happen. But it's usually pretty binary. The company's going to be around for a long time, or it's going to die pretty quickly. I mean, there's always the ones that kind of just, they call them the walking dead, but you kind of will know after about 5 to 7 years.
All right, go ahead.
Okay, another question. I recently read a book by 37 Signals called Rework. And also in this 37 Signals advocated the idea that then venture capitalist is bad for the startups. And there are 2 points I would like for you to comment from their point of view. The first one is that when a VC comes into the company, they'll demand quickly to have some solution and products ready in order for the market to begin to sell them, to get the money back. So they say the pressure to get fast results will result in sloppy products. First one. And the second one is that when you get the money, you get overexcited and you overstuff and you grow too quick, and then you also have some serious problems. I would like to ask you the questions how you handle those 2 moments.
I guess I'll take it because I know those guys. I'm from Chicago originally. I mean, yes, I agree. When you take money from a VC, the clock's ticking. You better show results, right? So if you are not in the mood to kind of really start driving hard and kind of be by someone else's schedule, don't take the money. I mean, my first company, I didn't take 1 cent from anybody. I was my own boss, and I could do everything I want. Yeah, the minute you do take money, you are your own boss, but now you have to talk to somebody, you have to answer to somebody, right? So as a company, you have to sit down and evaluate, like, okay, is this my personal style? Am I cool with having this person on board? Am I ready to kind of take this next level and then have, different results? Am I willing to, go out there and hire more people that maybe I don't want to, right? Your second part of the question is that bringing in money makes people sloppy, right? I think this is a case definitely a long time ago, right? Like 10, 15 years ago, like if you took money, you had like 30 million bucks, you had to spend it. People grew way too fast, too quick because they want to kind of show growth. They want to kind of, I think people are now coming to the realization that you don't have to take the most amount of money. You want to kind of right size your investment, right? So if you only need $200,000, only take 200,000, right? And push back. Some of the VCs want to, give you more money so they take more percentage of the company. So I would just, try to figure out what the right number is so you don't become a big fat cat and become sloppy and overhire and, bring in crappier people. Just kind of take your time, evaluate, like, okay, this is exactly what we need the money for, what it is, and then with that number, let's say it's 400, take it and multiply it 1 by half because you will always miscalculate your assumptions, but don't take too much. And so just find the right size. I really can't stress that enough.
And I would totally disagree with the first statement because the implication to what you said is that you take the money and all of a sudden realize that they want results. This cannot happen. You should have your timetables aligned before and expectations aligned before you take the money. Because if you take the money and you have this kind of surprises, the process definitely was flawed. Yeah. And you're gonna fail.
My point was definitely trigger some discussion on this point, and my point is that I'm okay. If you don't follow any time schedule, okay, it's your fault. You're not ready to get some VC capital, etc. But if the time is ticking and you get a sloppy product just to get it on time, I think this is not a very good idea. And maybe sometimes in investment, I don't know, it's a point. I'm not that experienced in VCs and etc. Maybe you have some experience with companies that has come with a sloppy product because their time was ticking too fast. They did not plan everything ahead.
No, but usually also the market is demanding that you have to be quick. I mean, if you're just developing the product for 3 years, then most probably the market's gone. And in our case, usually we get business plans, and then after our term sheet or whatever, our negotiation with it, we get adjusted business plan, because all the promises from the entrepreneurs from the beginning are then slightly, that means 60 or 70% adjusted to their previous ones. Because when they see, we always invest in tranches, so they don't get the whole pile of money on their account. And we usually invest as equity plus some convertible loans. And the conversion rate on those loans depend on their achieving their plans. And then when they make their math at home, they can see what that will mean for their company and their ownership structure, and then they come back with adjusted business plans.
Yeah. One other question regarding your second question. I think it's extremely relevant to the current environment, and I'll explain in a minute why. But I'll come back to the corporate governance, because the role of the board is to make sure that you don't overspend. Okay, because you have all this money all of a sudden. You before that you didn't have money to buy a car. all of a sudden you have millions in the bank, okay? So there is a natural inclination to spend. But this is why good corporate governance helps you because of it's gonna keep your spending in check. And it's relevant for what's happening today because I had a discussion with an entrepreneur, actually quite an interesting company, and we were discussing about the current bubble. And I was telling him that this is bad. Increased valuations, frothy valuations are bad for companies themselves. And he said, yeah, but why should I not take 20 million if I can at the moment, right now? And the problem is this: if you take 20 million and you spend 20 million and you make an exit at 20 million, you get 0. If you get 5 million and you spend 5 million and you get to an exit at 20 million, you get 15 million, which is the difference, because all VCs will require a 1x liquidation preference at the minimum, okay? So the investors will get the money first, you will be left with nothing. So this is why it's bad to take more money than you need. This is why frothy valuations are bad for you.
Oliver Bricky?
Yeah, just from my personal experience, I totally 100% believe that there is a problem of overfunding and too much funding, too early funding. My first company, we started in 98, 99, we were right in the middle of the .com bubble, got 4 million, didn't have a product ready, and suddenly our plan was to open up offices across the globe, basically. And so we did. I mean, the smartest thing we should have done was to show the plan and then immediately after the funding, adjust the plan. We were not that smart back then, but there is a big problem that people, you really have to first find the match, the market product match, as Mark Andreessen pointed out, before you really start to scale your business, and getting too much money too early drives you away from that. So I have very much, plus that valuation issue is a critical one. So don't talk to VCs too early.
Okay, I have one final question for you. Fishermen, stereotypically, are supposed to talk about that one big one that got away. Now, you guys are secure in your positions. You have nothing left to prove, but to be honest and embarrass yourselves. Looking back at your career as an investor, have there been companies that you have given a pass on, that you have said no to, that somebody else picked up and that became hugely successful and rewarding for the VCs? And if so, which one or which ones were they?
I can give 2 examples. I had an opportunity to invest in Mint.com, and I didn't. That kind of sucked. As first, 5 investors in that. I also personally, I had an offer to become like the 5th or 6th employee at PayPal, which I ended up to sell for 1.5 billion. I passed on that. So yeah, it sucks, but what can you do?
Yeah, we are bound to make this kind of mistakes, and I do have a personal example which could have been happening here in the region. I will not name the company, but we also have significant successes, and I mean this is what makes life worth living in the end. You miss some, but you make some.
Yeah, so my investment history is too short for that, but as an entrepreneur, when we sold our company in 2006, we thought about what do we do next, and the logical thing would have been to do mobile advertising, because we've been in the mobile space forever. And I was, no, mobile advertising will never work. Nobody will make money out of this. So we passed on that, and it would have been really easy to do. And then 2 years later, all my friends in the business already sold the next company around mobile advertising. So that sucked.
And we are very glad that mobile advertising did well, because one of our investments is active in this business. Otherwise, our investment history is very short. But yeah, there was Zemanta. Of course, we didn't have our fund in place at that time, but we knew the guys. We could find go a different way. But yeah.
Alrighty. Thank you, gentlemen, and thank you all of you who bothered to listen, and especially those who asked them questions. True crowdsourcing. Love that.